Hello everyone, this is Dr. Hessa Al-Fadhel, the course coordinator of Accounting 112. In this video, I'm going to explain Chapter 3, Part 1. The chapter title is Adjusting Accounts for Financial Statements. Please pay attention, this is a very important chapter in this course. The first learning objective is to explain the importance of periodical reporting and the role of accrual accounting. As you can see here that we have what we call accounting period, and usually we know that the year includes 12 months starting from January till December. But in accounting, we can divide the accounting into different periods. We have annually, we have semi-annually, we have monthly and quarterly. When we say that the accounting period is annual, which means that it includes 12 months starting from January till December, so it's one period. But when we say semi-annually, it means that we are dividing the 1 year into 2 periods. The first period includes the first 6 months of the year, and the second period includes the other 6 months of the year. So we call it semi-annually. Remember, semi-annually means that I divide the year into 2 periods. The first 6 months is one period, the other 6 months is the second period. When I say monthly, it means that I'm treating each period of each month. When I say quarterly, here I divide the year for 4 periods. Every 3 months, I'm going to call it as a period. So from January till March is one period. From April till June is the second period. From July to September is the third period. From October to December, it's the fourth period. That's why we call it quarterly, which means 4 periods every 3 months. Okay, let's talk now about the accrual basis accounting versus the cash basis accounting. So you need to differentiate what is accrual basis accounting and what is cash basis accounting. Technically here, we'll be talking about revenue and expenses, how we are going to record or recognize the revenue and expenses under the accrual basis, and how we are going to recognize revenue and expenses in the cash basis. So there is differences between them. So let's focus on the accrual basis now. We already know in Chapter 1 and in Chapter 2 when we are going to recognize the revenue. We said that in order for me to record or recognize the revenue, first the service should be completed. If the service is completed, then we are going to record it as revenue. And also we talk about the expenses. We said that when the expense is anchored, it means it should be recorded. If you remember the example of salaries payable, we said even though that the company did not pay the salaries, they have to record it. Okay, so this is on the accrual basis. The cash basis is the opposite. When they receive the cash, they are going to record the revenue, even though the service is not completed yet. And they are going to record the expenses only if they pay. If they pay cash, then they are going to record it as an expense. If they receive the cash, then they are going to record it revenue. They don't care about if the service is completed or not. So this is the difference between the cash basis and the accrual basis. Accrual basis will focus more on the service if it's completed or not, and they are not gonna care about the cash. If the cash received, but the service is not completed under the accrual basis, the revenue is not recognized. But in the cash basis, they are going to focus only on the cash. We received the cash, I'm going to record it as a revenue. I paid cash, then I'm going to record it as an expense. But you have to remember that in this semester or in this course, we are not focusing on the cash basis. We don't care about the cash received. We are caring only if the service is completed, I'm going to record it as a revenue. If the expenses is anchored, then I'm going to record it as an expense. Okay? The second learning objective is to prepare and explain adjusting entries for deferral of expenses. Please pay attention as this is an important topic. Let's start with the first type of adjusting entries. The payment of cash before the expenses is recognized. If you remember, in Chapter 2, we already talked about the prepaid expenses, or what we call it prepaid accounts. We said that prepaid expenses or prepaid accounts are assets paid for in advance of receiving their benefit. One of the examples of the prepaid accounts, which is prepaid insurance. As you remember in Chapter 2, I provide you with an example of a car. If you have a car, we usually needs to pay an insurance for the car. And when we are going to pay the insurance, we pay the insurance for 12 months in advance or 24 months in advance. Since that we did not use the money of the insurance yet, we record it as an asset. So as you know that if you are paying in advance for an insurance for 24 or for 12 months in advance, then you have to record it as a prepaid insurance. And prepaid insurance is going to be recorded as an asset. But if you did an accident and you used your insurance, then you need to expense it. So let's see here this example of prepaid insurance. They said here in step 1, fast forward, they pay $2,400 to cover insurance for 24 months that begins on December 1st, 2019. So now fast forward, they pay $2,400 for an insurance. For how long? For 24 months. So now we know how we record the journal entry for that. Because we paid, my cash is going to decrease. And because I'm paying in advance for an insurance that I did not use yet, so I'm going to say prepaid insurance. So prepaid insurance will be on the debit side because I did not use the money yet. I just buy the insurance. So my prepaid insurance will increase and my cash will decrease. Why cash decrease? Because I paid. But now let's focus on the prepaid insurance. You can see here there is a T account of the prepaid insurance. And we said that we paid $2,000 to cover an insurance. So because we pay it in advance, so what will happen to my prepaid insurance? Prepaid insurance, because the money, I did not use the money yet, and prepaid insurance, it's an asset. So it's going to increase on the debit side by $2,400. Now let's see step. Okay, let me remind you here. In step 1, we purchase the insurance policy on 1st of December 2019. And we said that because we purchased the insurance in advance, that's why we record it as a prepaid insurance and we consider it as an asset, and then we record the $2,400 on the debit side as shown in the T account. But now the time passes over the time, and when we reach to 31st of December, after a 1 month of purchasing the policy, we've been using this insurance policy. The insurance policy has expired. What do you mean by expired? It means I used it. Did I use it for 24 months? No, I used it for a month from 1st of December till 31st of December. So I used the insurance policy. As you remember, as I said earlier in chapter 2 and earlier in step number 1, that if you purchase the insurance and you did not use it, you record it as an asset. But if you used it or you expire it, you need to expense it. Now they are telling me in step 2 that they expire it, which means they use it for a month. So now I need to expense my insurance. But should I expense 2,400? Did I use the 2,400? No, I only use 1 month from the 24 months that I purchase. So I will say 2,400 divided over 24 months. So it means that for 1 month I expire 100. So now because I use 1 month, so I have to expense 100. So because I use it, my expenses are increasing on the debit side. So as I said, because I used or I expired the insurance, but I did not expire it, of course, for 24 months. I only expired it for 1 month. So now my balance of my prepaid insurance will be 2,300. And as you know, prepaid insurance, it's an asset. Where I record the prepaid insurance, because it's an asset, I have to record it on the balance sheet. But insurance expense, it's an expense. Remember, I have to record the expenses in the income statement. So insurance expense should be recorded in the income statement because it's expense. And prepaid insurance should be recorded in the balance sheet because it's an asset. Now, this is the important part of the chapter. Now I have to prepare adjusting entry for prepaid insurance. If you remember in chapter 2, we talked about the general journal entry. And we said that the journal entry, it's 2 lines. The first line represents the debit. The second line represents the credit. But now, remember, you're going to prepare adjusting entry. Now, already we said that the prepaid insurance is 2,300 and the insurance expense is 100. So now when you're going to prepare the adjusting journal entry, again you have to record the 2 lines. So now which one you're going to put it on the debit side, which one on the credit side? So insurance expense should be on the debit side, on the first line. Why? Because we have 100 on the debit side. But for the prepaid insurance decreases by 100 on the credit side. So now when I'm going to record my adjusting journal entry, I'm going to say insurance expense 100 on the debit side to prepaid insurance 100 on the credit side. Remember here, when you're preparing the adjusting entries, you're not going to record the balance, you're going to record what did you use or what did you expire. So now let's see the second example of adjusting for supplies. In step 1, they say that fast forward, they purchased 9,720 of supplies in December. And they say some of these were used during December as well. So we know now that fast forward, they purchase supplies. So if we purchase, which means my cash is going to decrease, but my supplies is going to increase. By how much? By 9,720. So that's why when we purchase during December, my supplies increases in the debit side by 9,720. Why on the debit side? Because supplies, it's an asset, and the normal balance of the asset is debit. So when it's increasing, it's going to increase on the debit side. But then in step 2, they told me at the end of December, they were counting what they did. Usually every end of each year or each month, the company needs to count how much left from the supplies. So when they did a physical counting, they found that the supplies is not 9,720, but the supplies after the physical count is 8,670. So how come that I purchased supply of 9,720 and at the end of the month I ended up with 8,670, so there is a decrease. So what does that mean? It means that if my supply is decreasing, it means that I used the supply. So how much did I use from the supply? It means that if I say 9,720, minus 8,670, it seems that 1,050 is the used supply. So we used during the month 1,050 of supplies. That's why it's decreasing on the credit side. Okay, so it means that we use the supply. If we use the supply, we need to prepare an adjusting entry. So if you use or you expire, you need to prepare an adjusting entry. And here in our example, they told me that they used 1,050 of the supply. That's why my supply is decreasing. So now let's go and see step 3. So now in step 3, we know that the supply is decreasing. Okay, the supply is decreasing by 1,050. Why 1,050? Because I used them. And remember, when we use, it means that we expense. If you use or you expire, you need to expense it. Now my supply is decreasing by 1,050. Why is decreasing? Because I used them. If the supply is used, it means it will decrease my supplies. And because I use them, it means that this is an expense. So that's why I need to record or post two accounts, supplies and supplies expense. Why I need to record supplies expense? Because I used the supply. So it means that I expense it. Because I use the supply and it is an expense and my expense is increasing, I'm going to record 1,050 on the debit side as shown in the T account. So now how much is my total supply? My total supply is 9,720 minus 1,050. Why 1,050? Because I use them, so it means my supply is decreasing. So my total balance of supplies is 8,670. And because supplies, it is an asset, where I'm going to record it in which financial statement? I have to record it in the balance sheet because supply is an asset and the asset should be recorded in the balance sheet. What about the supplies expense? Supplies expense, it's an expense, and all of the expenses we usually record them in the income statement. So now let's move on to the important step. So the adjusting entry is the important step. Now, as I said earlier, that the journal entry is 2 lines. The first line represents the debit account. The second line represents the credit account. And now I'm going to prepare adjusting entry. So now, as I said earlier, that the supply expense increased 1,050. Why increases by 1,050? Because I used them. I use the supply. Since I use it, I have to expense it. And again, I have my supplies decreases by 1,050 on the credit side. So now my expenses increases on the debit side and my supplies decreases on the credit side. So when I'm going to prepare the adjusting entry, I have to start with supplies expense to supply. By how much? By 1,050. Remember, when you are preparing the adjusting entry, you need to record the number, how much did you use or how much did you expire, not the balance. Why I record supplies expense on the first line? Because supplies expense is increasing on the debit side, and this is a journal entry. So the first line always represents the debit account. Supplies is on the credit side, so that's why it's on the second line. And again, I don't record 8,670, I record 1,050, the amount that I use. Why? Because this is an adjusting entry. Remember that. Now we'll talk about depreciation. And we usually depreciate what we call plant assets. So let us first explain what is plant asset. Plant assets are tangible assets that we use for operation, and it has more than 1 year expected life. Let me give you here an example. In University of Bahrain, the main service that the university is providing is education. And for us as an instructor, to provide you with this education, we use PCs to operate this kind of learning process. So we use the PCs in the classroom for operation, not for selling. So the PC that we have in University of Bahrain, we don't use it to sell them. We use them for operation, to deliver the classes. So that's why I can call the computers in the classes at University of Bahrain as a plant asset. Why as a plant asset? Because I use them for operation, not for selling. Let's say, for example, that the university purchased a PC and this PC cost them 350 BD. So when the university purchased it, they pay 350 BD. Now, do you think that the PCs, we only use them for 1 year? Not at all. We use the PC for like 5 year maximum. So now, you purchase it for 350, but after a year, do you think that it will still worth 350? No, it will worth less. Say, for example, after year 1, it's going to be worth 300. And in year 2, we are expecting even the PC to be even worth less, 250 maybe. And in year 3, we are expecting maybe the computer or the PC to be worth 200. So we can see that the value of the PC is going down or reducing. Why is that? Because we are using the PC. Since you are using it, it means that the worth or the money or the value of the plant asset is going to be decreased. Let's say, for example, until the 5th year, we are expecting the PC to be worth 100 BD. So this is what we call it depreciation. It means that the value of the plant asset will keep decreasing each year. And depreciation is the amount or the cost of usage per year. So the depreciation will tell me how much each year I have to decrease my plant asset. How much did I use it and how much did I need to decrease it per year. So this is what we mean by depreciation. We're going first to allocate, or we spread out the cost over the expected useful life. To understand it more, let's see the example. Okay, so the first step is, now you understand what is depreciation in the previous slide. Now let's see how we can calculate the depreciation. Usually when we calculate the depreciation, we use a method, we call it straight line depreciation method. How to calculate the depreciation using the straight line method? It's about the asset cost minus salvage value over the useful life. Now we know what is cost mean. In the previous example, we said that we purchased a PC for 350. So it cost us 350. So we know how much is the cost. So now what is minus salvage value over the useful life? So what do you mean by useful life and salvage value? The useful life, it means here how long I'm expecting this PC to be working for. How long it will last with us. Of course, not 1 year. Of course, not 1 year. We don't use PC for 1 year and we throw it away. So it will be more than 1 year. So let's say, for example, we purchased the PC for 350 and we expect this PC to last or to be working for example, 5 years. So the useful life is 5 years. So I'm expecting the computer to be working and will generate for me revenue for 5 years. Then what do I mean by salvage value? Salvage value is how much the value of the PC will worth in the 5th year. Of course, you are going to use the PC for year 1, year 2, year 3, year 4, year 5, and every year the value of the PC will decrease. Then until the 5th year. And the 5th year, we are expecting how much is the value of the PC will be worth. This is what we call salvage value. Salvage value means the expected value of the asset at the end of its useful life. How much is going to be worth the 5th year. So this is the salvage value. So to understand it more, let us see now an example of the depreciation. So here we have in step 1, they told me that fast forward, they purchase an equipment on 1st of December and it cost them 26,000. So we purchase an equipment and it cost us 26,000. They say that it has an estimate useful life of 5 years. So we are estimating that this equipment will be used for 5 years only. So this is my useful life. Then the equipment is expected to be worth 8,000 at the end of the 5th year. So we are expecting in the last year, the 5th year, the equipment will be worth 8,000. So this is what we call it salvage value. Salvage value, it's 8,000. How did I know this is a salvage value? Because they are saying that we expect the equipment to be worth 8,000 in the end of the 5th year. And if you go back to the previous slide, you will see the definition of salvage value, which is the expected value of the asset at the end of its useful period. And then they told me that they purchased the equipment on December 1st, but now is December 31st. So we purchased the equipment in December 1st, and now we reach to end of December. So of course, I've been using this equipment now for how long? For 1 month. So I need to adjust my entry. Why I need to adjust? Because now the value of the equipment is no longer 26,000. Why? Because I used it. I used it for how long? I used it for a month. How did I know that I used it for a month? Because I purchased it 1st of December and now it's 31st of December. So I've been using this equipment for 1 month. So now I need to calculate my depreciation. Why I need to calculate my depreciation? Because I used the equipment for 1 month. So they say here, because the fast forward expects the equipment to worth 8,000 when the 5 years are over, only 18,000 of the cost needs to be spread over the next 60 months. Okay, now let's see here the calculation. So how we can calculate? As you know that to calculate the depreciation using the straight line method, we need to take the cost minus the salvage value over the useful life. And we said that the original cost of the equipment when we purchased it, it was 26,000. So minus the salvage value, and we already said in the previous slide that the salvage value is 8,000. So 26,000 minus 8,000 is 18,000. So now I need to divide the 18,000 over the useful life. So let's see So as I said earlier, that when we are calculating the depreciation, we usually take the cost minus the salvage value over the useful life. Already in the previous slides that we already deduct the cost, which is 26,000, minus the salvage value, 8,000, and then we get 18,000. So now this 18,000, I have to divide it over the useful life. Take care here. Here they want me to calculate the depreciation not for a year, they want me to calculate the depreciation per month. They did not ask me to calculate the depreciation for a full year because I need now to calculate the depreciation for a month because I purchased it 1st of December and now I reach 31st of December. So I only use it for 1 month. So now I need to calculate the depreciation per month, not per year. So in this case, I'm not going to divide it over 5 years. I'm going to divide it over 60 months. Why 60 months? Because I have 5 years. 5 multiplied by 12 months per year. So I have in total 60 months. So I'm going to divide it over 60. So my depreciation now for 1 month is 300. But if they ask you, here the question is asking for 1 month only, but if they ask you to calculate the depreciation per year, then you have to divide it over 5. Okay, so now my depreciation is 300 for 1 month. Now let's move on with step number 3. And step number 3, as you can see, that when I'm going to record the T accounts, of course, in 1st of December, what I did, I purchased the equipment, so the equipment will increase on the debit side as shown in the T account. But now when I used it, on 31st of December, I used the equipment for 1 month. Then I calculate the depreciation as I did earlier. I take 26,000 minus 8,000 divided over 60, and I saw that my depreciation or my usage for a month is 300. So now I need to decrease my equipment for 300. So in accounting, when we are adjusting for the equipment or for those depreciation, we usually have two new accounts for the adjusting depreciation. We have something what we call it depreciation expense and something what we call it accumulated depreciation. Make sure that you, I'm not going to say memorize it, but you understand it by heart. Whenever we say depreciation or calculate the depreciation, you have to remember two things, two main accounts that you have to remember when we're talking about depreciation. This depreciation expense and accumulated depreciation. And the depreciation expense will increase on the debit side. Why? Because my expenses are increasing, and we have something what we call accumulated depreciation. And the normal balance of the accumulated depreciation is always credit. So now let's talk about the important part of the chapter. Now, how I'm going to record. Now, I calculate the depreciation using the formula, using cost minus salvage value over the useful life, and I calculate it for 1 month. Now, I already post them in the T account. Now, the most important part is how I'm going to record the adjusting entry. So now to record the adjusting entry for the depreciation is adjusted because the equipment is used for how long? For 1 month only. So I need to record adjusting entry. How I'm going to record the adjusting entry? As you remember, the adjusting entry, when I say entry, it means that I'm talking about the two lines. The first line which represent the debit side and the second line which represent the credit side. So now, how I'm going to record the journal entry? I'm going to say depreciation expense because the depreciation expense, it's increasing on the debit side. So I'm always going to record the entry that increases on the debit side. And then I'm going to say accumulated depreciation 300 and 300. How did I get the 300? After using the formula, which is cost minus salvage value over the useful life. Remember, whenever they talk about depreciation, there is only one adjusting entry. It's fixed. You will always say depreciation expense to accumulated depreciation. So now my question is, now depreciation expense, it's an expense, and we usually record the expenses in the income statement. But what about the accumulated depreciation of the equipment? Where should I record it? I have to record the accumulated depreciation. Okay, it's not an expense, accumulated depreciation. Accumulated depreciation, it should be recorded in the balance sheet. Okay, in the balance sheet. Let's see now how we are going to record it. So now if you can see, this is a partial balance sheet. It's not a full balance sheet. It's just a part of the balance sheet, only the asset side. So we can see that the equipment here is recorded by 26,000. So this is 26,000. We always record whatever we purchase on the actual price. How much did we purchase it? We purchased 26. But now because we purchase it and we are using it in operation, so we need to depreciate it because we are using it. And we did the depreciation. As I said earlier, depreciation expense is not going to be reported in the balance sheet. Depreciation expense is going to be recorded in the income statement. But accumulated depreciation, we report it in the balance sheet under the equipment. Okay? And why here we wrote less? Because the accumulated depreciation reduces the main account of equipment. So now, after 3 months, because we purchased the equipment on 1st of December, and this is on 28th of February. So it means that from 1st of December 2019 till 28th of February 2020, it means 3 months. So that's why I'm going to deduct 900. Okay, so 26,000 minus 900 will give me 25. So after 3 months of using the equipment is no longer 26,000. The equipment worth 25,100. So you have to remember, accumulated depreciation should be recorded in the balance sheet. This is the end of chapter 3 part 1. Please check the video of chapter 3 part 2.